let's keep it going here. It's 10:10. Hey, did you guys see the VIX lately? The VIX just within the span of a week or two, it doubled, right? We went from 15 to 30. Volatility spiked. What do you do when that happens? Our next guest can tell us. His name is Bryan Sapp. He's a senior market strategist at Schaeffer's Investment Research. Hey, there he is. What's up, Bryan?
Hey, how's it going? Thanks for having me.
All right, we're talking volatility. We're talking trading in the volatile markets in periods where the VIX is going higher, which we just had for a couple of weeks. So, do we have your screen share ready? I think we do. All right, then the floor is yours, sir. Tell us what exactly is going on here.
Okay, so you said, the VIX spikes to 30. What do we do? Well, hopefully you're positioned ahead of that spike, because once it spikes to 30, it's generally too late, right? Like if you're putting on hedges after the vol's already spiked, then you're probably in trouble, and or you got washed out of a lot of your long positions. So this is a strategy that we've developed. We're going to talk about buying straddles and using volatility to try to double your money. Generally, we'll put about 100% target on these trades, and we're just going to go through what we like to look at and what could be some potentially good situations and the benefits of it over time. So first off, we're going to talk about some terminology, some benefits of it. We're going to talk about volatility as an asset class, like the trends that it takes over time. Some technical analysis patterns to look for to define potentially volatile situations. Some catalysts and indicators that we like to overlay with those technical indicators. And then we're going to go over a trade that our subscribers just received to kind of give you an idea of what's what. And then if you have any questions, hopefully we'll have a few minutes at the end. So feel free to write those down and ask me those. So first off, what is a straddle? A straddle is a simultaneous purchase of a call and put option with the same strike price and expiration date. You can structure these directionally if you'd like, or market neutral. So for example, if a stock's at 150 and you buy the 145 strike straddle, that position has a little bit of a bullish lean to it, even though it's a hedge position. And if you were to buy the 155 strike straddle, that would have a little bit of a bearish lean to it. At Schaeffer's, typically what we like to do is just trade market neutrally. And historically, my best trades, my biggest winners have come in situations where I honestly had no idea if the stock was going up or down, or the ETF, or whatever it may be. So the way that you make money buying straddles is you profit via an increase in implied volatility and or price moves in either direction. And as a general rule, when you get price moves, implied volatility will follow suit. The price of the options will get bid up as the stock or the ETF becomes more volatile. And again, as a buyer, you don't care if it goes up or down. You just want movement. Just do something. So here are the benefits of trading them. First and foremost, you get a diversification of strategies within a portfolio. For people that trade options or long only, the recent washout that we had, and especially in the small caps, that probably hurt a lot of people. If you use this strategy in conjunction with your other positions, it's going to give you a hedge. So, when COVID happened last year, the market just flushed out, and we had a ton of just huge winners in this service because obviously the market was collapsing. So it can help kind of cushion that blow that you might take from the rest of the market. Now, additionally, these can do well in trending markets. Generally low volatility trending markets, you'll have a lot of, stocks that participate on the bullish side, and you'll get big winners on that. So it can kind of work in both kinds of markets. The market that's kind of the kryptonite for this strategy is a mean reversion. So if you just get long periods of chop, the volatility gets sucked out of the options, and that can be tough. But that's the one time where it's generally tricky to trade these types of things. Another benefit of trading these is with any option trade, you have defined risk in each position. You're buying options. The most that you can lose is your outlay, the premium that you purchased. So when buying options, you can use option convexity to your benefit. The P&L chart for straddle is similar to that of like a call or a put option, where you can have huge winners in a short period of time. And it's not too uncommon to see 200% and 300% winners in these positions, which are hedge positions, but can still work out really well. The advent of the weekly options has been huge for this. There's so many stocks now that trade weeklies. They have expirations, every week, months out. You can really hone in on what the best time frame is, what the best option is to buy in those situations. And then lastly, you have a low probability of a large loss. So in order to take a complete loss on these positions, you'll have to hold it until expiration, and the stock will have to close at exactly the strike price that you bought on expiration. Very, very highly unlikely. And you can manage risk as you go. There's different ways to manage this, but just the probability of taking a complete crap out on a position like it is very low compared to buying an out of the money call or put, which has a very high probability of taking a large loss. So we're going to shift gears a little bit and talk about volatility, what volatility does over time. And this applies to virtually any risk asset. It can be crypto, it can be stocks, real estate, gold, whatever it may be. You get these periods of volatility compression, and then you get periods of volatility expansion. The way to think of it maybe is like you get an impulse move in a stock, and then it churns sideways for months, and then you get another impulse move. And the impulsive moves are generally on heavy volume, and they generally happen quickly. The analogy that I like to use is like a coiled spring. So, you know, your click pin, if you take that little spring off the inside of the pin, and you take it and you squeeze it, you're essentially compressing energy into that spring, right? And the more you squeeze it, the more energy that's in it. And as you let go, the spring might shoot across the room or hit the wall or whatever it may be. Stocks behave the same way. I'm sure a lot of people have heard the adage, the longer the base, the higher in space. Same principle. If you get something that consolidates for a long, long period of time, when that eventually breaks, you're generally going to get a big reaction. And the longer the consolidation, the bigger the reaction. And then lastly, this is really important. During consolidation phases, the implied volatility of options gets sucked out of it. The stock's not moving. There's not a lot of demand for options. The option prices go down. So as a straddle buyer, if you're trying to buy during that consolidation phase, you're trying to predict the impulse phase. Well, option prices are generally really low during those consolidation phases. So if you can time the breakout, you're going to get the most bang for your buck, and you're going to be buying the options at their most cheap, basically. So this is just a long-term chart of the VIX. This is a weekly chart. And you can see this impulse consolidation. So, an 18 impulse, long consolidation, little impulse, another consolidation, back and forth until, you had this long consolidation at the end of 19 and then the big blow up during COVID. So, the VIX went from 15 to 85 in a matter of a month. So had you been buying straddles in here at, early 20, it would have been a massive windfall for you. And you probably, would have made a lot of money during that period. So how do you predict when these impulses are going to happen? I like to start with a technical strategy. I sort of start with charts and then kind of dive deeper from there. And I can't go through all these, but you can look it up like on Investopedia or whatever if you're unfamiliar with these. They're pretty common technical patterns, and they're all consolidation patterns. So triangles, symmetrical, ascending or descending. Symmetrical triangles are probably my favorite pattern to trade with this strategy. There's not a lot of those setups out there right now, but you can still find them if you look hard. Rising and falling wedges, bear and bull flags, and then sometimes you'll get long, kind of sloppy consolidations at key price levels. Let's say, for example, 80 was key resistance 3 years ago, and then it was critical support last year, and then the stock has just been kind of churning around the 80 level for the last few months, whatever it may be, in a range. When that range breaks, given the historical price action around that level, chances are you're probably going to get a big move away from it, whether it be up or down. And again, if you're in straddles, you don't care up or down. You just want it to move away from it. And then you can use some technical analysis, and you can use the measured move principle to determine where the stock might go if that pattern breaks out. Now, this is really important, this note. None of these patterns should be used in a vacuum, but when combined with sentiment and option analysis and a catalyst, they provide a significant edge. So we're trying to layer multiple things on top of each other to give ourselves an edge and say, okay, for these 4 reasons, that may be why I'm going to enter this straddle right now. So catalysts, this is really important, and this applies to all option trading. Whenever you buy an option, especially when you buy double premium, when you're buying a call and a put, you need to have a why now. There's an embedded time premium element to these options. So from the instant that you click the buy button, time decay is working against you. So you need to have a reason why this stock or ETF can move in the very near future for you to enter the option. You have to be right on the time frame. And if you're buying, calls or puts, the direction, but with straddles, obviously it doesn't matter. So what do we look for? Like, what are some potential catalysts? Obviously, earnings are the big mover for stocks. For macro things, you may have Fed rate decisions, macro data. peer earnings. Let's say like, United Airlines is reporting earnings in 3 days. Delta's options haven't been bid up, as much as they should have. So you might get a sympathy move with United's earnings. So it might make sense to buy Delta options, that sort of thing. Investor meetings, conferences, FDA results on biotech companies, things like that. So we found that 1 to 2 weeks ahead of the actual event, that's going to be the volatility sweet spot. So the worst thing that you can do as an option buyer is go out and buy a call or put like the day of earnings or right ahead of earnings. The reason being is those options are bid up because everyone knows that earnings are coming. Everyone's speculating on that. And so the price of the options get bid up. The implied volatility gets bid up immediately ahead of the event. If you buy a week or two out, you're generally buying lower vol. And as the event approaches, the implied volatility will increase and that will offset the time decay. So you kind of get like a free ride for a week or two, and anything can happen in that week or two. So you're buying lower vol, you get a wider window for something to happen, and the implied volatility rising into the event is going to benefit your position. And then lastly, let the implied volatility term structure decide the trade's time frame. Again, with the earnings example, if a company reports on Thursday, you probably don't want to buy options that expire the very next day. Reason being, if you're wrong, you're going to take a huge loss. If you buy further out, the implied volatility is going to be generally lower. You're going to get more time for that position to work out. You potentially could get a much bigger winner by giving it another week or two past the event. And the implied volatility is going to be lower. And additionally, you'll have a little bit of a cushion beyond the event. So there will still be some time premium left in that position if you decide to get out of it. So the loss will be smaller generally. So some indicators that we like to look at when finding stocks that may be good straddle setups. First and foremost, short interest. It's no secret that stocks that have high short interest, they're more volatile than stocks that don't have high short interest. And additionally, I like seeing big rising trends in short interest. So if you can find something that's at 5-year highs or whatever, you have the potential for a big event. You have the potential for those shorts to capitulate and or pile on even more, and you can get a big price move from that. Extreme readings and put call ratios, similar to the short interest. If you have a ton of call buying or put buying, there's some things that go on underneath the surface with the market makers. Those people holding those options, if they decide to close those, you'll get an unwind, and that can cause a lot of price movement in the stock. A technical indicator that I like to use is I like to look at Bollinger Bands. And basically what Bollinger Bands do is they plot 2 standard deviations above and below the current price, and it gives you like a volatility range. So when the bands are wide, that's basically telling you that the stock has been very volatile recently. When the bands are very narrow, that's telling you that the stock has not been volatile. And that ties in with that compression expansion idea that I told you earlier. When the bands are very narrow, volatility is compressed, that could be a sign that something is about to happen in the near future. If you see an uptick in volume, let's say the stock wasn't trading much at all, and then the past 2 days it's traded 2 times the average daily volume over the last week, that could be a sign that something's happened. That means that big money is coming into that stock. Big money can obviously move stocks more than the retail money, so that's something else to look at. And then lastly, cheap options. When you're buying options, cheap is good. When options are expensive, you typically tend to sell them. When options are cheap, you typically tend to buy them. So just a little example of a trade that we sent out to try to bring all these concepts together that I just told you. This was a recommendation in our weekly volatility trader strategy that went out on August the 23rd. It was about a 2-week expiration trade. And the rec was to buy the DraftKings 9-3, 53.5 strike straddle. We paid $3.20 for this. And this was our rationale for entering the trade. So first off, if you see these dotted lines, those are the Bollinger Bands. So you see in this area, they're pretty wide. The stock was volatile. They start to pinch because you get some consolidation. They widen again, yada, yada. So if you look right here, this green arrow is where we entered the trade. So if you look at these bands right here, they're very pinched. They're very narrow. So you've got vol compression. So that's one thing. Number 2, you have a technical pattern. It's a little sloppy, but this is an inverse head and shoulders pattern on a daily setup. So if this were to break in either direction, you're probably going to get a pretty big move on the resolution of that pattern. We use something called the Schaeffer's Volatility Index that looks at option prices, and it lets us know, cheap or expensive. At this given time, the options were priced in the 3rd percentile. So very, very cheap options on DraftKings at the time. You had multiple tests of this 200-day moving average, which is this blue trend line. Everyone knows that's a key moving average, probably has a lot of eyes on it. If and when that breaks either way, you're probably going to get a big price move. And then lastly, the Why Now, the Craig Hallam Gaming Conference was a couple days after we entered this trade. DraftKings was presenting at that event. Generally, if you get any sort of news or company updates, sometimes companies, they'll discuss guidance, whatever it may be. You have the potential for something to happen at that conference that could cause this vol expansion that we're waiting on. And then lastly, if you look down here at this blue rectangle that I kind of highlighted, you'll see the uptick in volume, right? You had very low volume. You had a little spike here for a couple of days, but low volume, little spike, low volume, and then it starts to spike again. So that was a sign that something could be happening in the very near future. So the way that we manage this, generally, if something hits 100% target, we'll take a half off, and then we'll let the rest go into expiration and try to get a little convexity working in our favor. So we took half off here to double, and then we let it run a little bit, and that was the second red arrow was expiration. So that's when we closed the remainder of the position. So 119% gain in 9 trading days, I think it was. So just an example. They obviously all don't work out like this, but I thought this was a good illustration of all the concepts that we just covered. So that's everything for now. Hopefully we have some questions. Hopefully I didn't confuse anyone, but if this is something that you might be interested in, take a look at our website. There's a lot of free content on there, a lot of educational type stuff. It's schaeffersresearch.com. You can follow us on Schaeffer's or at Schaeffer's, on Twitter. A lot of news information, a lot of free newsletters, things of that nature. So that's all I have. We have a couple minutes here if anybody has any questions.
Yeah, if you have any questions, guys, drop them in the chat for Bryan. We're coming into year end. It's always a time to, if not just reassess your entire outlook and portfolio, but consider what you have, what you're prepared for, what you're not prepared for. So thank you for all the information, Bryan. Let me just scroll here and make sure I didn't miss any questions, because there's a chance, because the chat is flying and I want to make sure. Okay, this one's like a practical question.
Okay.
Very specific from Jamie. All right, Bryan, quick question. So we're talking about ticker PATH here. But I'm just going to give you, I'll read, I'll bring it up on the screen. All right. PATH. Yeah.
Okay.
Trading at 46.70 right now. Earnings out tonight. Oh, that's interesting. Jamie, come on, Jamie. We can't give you specific advice like that. All right. I don't know, Bryan, if you want to comment. I'm sorry. I should have read the whole question before I put it up.
I can answer that right now pretty easily. If they have earnings out tonight, buying options right now is not a winning proposition. You missed it.
All right.
Yeah.
Here's a better one from Mitch. What is your favorite sentiment indicator?
Probably short interest. Trending short interests. Whenever that data gets updated every 2 weeks, and that's something we constantly monitor. When you get big changes in short interest, that can lead to big price moves in either direction. Maybe shorts pile into something, and then some positive news comes out, and they all have to scramble and cover, or whatever it may be. But typically the shorts are the big money. Those are the big funds, and those are the ones that can really make stocks move. So I would say that's probably my favorite one.
I just want to do a PSA on short interest. What Bryan just said is that, and he's absolutely right, the firm number we have is updated every 2 weeks from FINRA, okay? There are other short interest data points out there from other firms, but the official number is out every 2 weeks. So that's point number one. It's not updated real time. Point number two is I see a lot of people on like FinTwit will like hang their hat on short interest as being like the indicator to rule all indicators. And even though you said it's your favorite here, it is not the only one you look at. And it should not be the only one anyone looks at. A rising short interest is not the be all end all, right? It does not mean squeeze coming. That's not what it means. It means a squeeze can come, but it is not that simple.
Absolutely.
So,
I think context is very important when you use short interest. So if you have a stock that's rallying, that short interest is also spiking. So the bears are trying to hammer this thing and the stock keeps going up. that's a really good sign that a short squeeze could happen.
Yeah.
Now, if shorts are piling into something and price is going down, well, the shorts are winning, right? Like they're getting paid. The more they short, the more. So why would they cover if they're in the green? And the more, as short interest rises, the thing keeps trending down. So again, you can't just use short interest in a vacuum. You need to look at the total picture and the context of price and the context of what's coming up in the near future.
All right. Tell the people how they can find you, because I know there's more questions and we don't have time, unfortunately. So tell the people how they can find you.
I'm not very active on social media, but I will write for our website occasionally. I would say follow at Schaeffer's, and then a few of the other guys that I work with, they're a little more active on social media than I am.
All right, Bryan Sapp, Senior Market Strategist at Schaeffer's Investment Research. Bryan, thanks a lot for coming on the Benzinga Small Cap Conference today.
All right, thanks for having me.